Thank you, Chairman Harkin. I want to thank the members of the committee for having us today. You asked us to discuss the role of financial derivatives in the current financial crisis. Financial derivatives cover a very broad array of product types. They include regulated futures contracts, collateralized obligations packaged as securities, including subprime mortgage obligations, and pure vanilla swaps that are unregulated versions of futures contracts. Dozens of scholarly books and articles, as well as numerous class action and shareholder lawsuits, have attempted to answer your question. There seems to be a consensus that financial crisis is not a consequence of these instruments. It is linked to other factors, including distribution, collateralization, risk management, and trading and accounting for financial derivatives in the unregulated over-the-counter market. Financial derivatives are tools for managing a firm's risks. Like all tools, they are neither beneficial nor harmful in themselves. The dire consequences have occurred in the OTC market, where there has been a lack of price transparency and a failure to properly measure and collateralize the risk of those instruments. In stark contrast, trading in financial futures on regulated futures markets, subject to the oversight of the Commodity Futures Trading Commission, has been a net positive to the economy. It has caused no stress to the financial system and has easily endured the collapse of one and near collapse of two firms that were very active in our markets. This is a record of which this committee, the CFTC, and our industry can be justifiably proud. When Lehman Brothers filed for bankruptcy last month, no futures customer lost a penny or suffered any interruption in their ability to trade. The massive proprietary positions of Lehman were liquidated or sold with no loss to the clearinghouse and no disruption to the market. This tells us that our system works in times of immense stress to the financial system. Rather than looking back and trying to blame the unregulated market, we want to move forward. Let me explain how we are planning to help alleviate the risks to the economy currently represented by the almost $600 trillion in outstanding notional value of OTC swaps. We are in the process of offering a means to convert a significant portion of outstanding OTC interest rate swaps into regulated exchange-traded futures. If the dealers and their customers accept this program, we expect that we will see standardization of these outstanding contracts. In addition, our clearing system will permit a multilateral netting process. This process will reduce the outstanding exposure on the instruments submitted to clearing system by a factor of at least 5. Coupled with this reduction and appropriate mark-to-market and CME's margining expertise, and we are one step closer to coming to grips with this monster. I particularly want to focus on our plans to play a role in the credit default swaps market. The CDS market has grown because credit derivatives permit allocation and realignment of credit risks. These instruments are tremendously valuable financial tools if used properly. However, the individual and systemic risk created by the rapid growth of such contracts has been poorly managed. This mismanagement is due to several factors: lack of transparency pricing, lack of standardization contract terms, lack of multilateral netting, and lack of other advantages that flow from integrated trading and central counterparty clearing system. By not having these in place, we have compounded risk and driven uncertainty in the CDS market, which has a gross exposure of about $55 trillion. There is a solution. CME Group and Citadel Investment Group offer an effective method to monitor and collateralize risk on a current basis. It is estimated that portfolio compression by netting could shrink the $55 trillion of exposure by a factor of 10. This will help reduce systemic risk and enhance certainty and fairness for all participants. We are working with the New York Federal Reserve, the CFTC, the SEC to find a way to bring our solution to market quickly. We are encouraged that the regulators are highly motivated to contain the problem without delay. If they continue to work together, we feel that we will be able to eliminate the jurisdictional and regulatory uncertainties that might otherwise delay a solution. I want to thank the committee for holding this hearing today, and I look forward to answering your questions. Thank you, Mr. Chairman.
Mr. Duffy, thank you very much for that testimony.